Picking the right whole life insurance policy is one of the most important things to do, and it's also one of the hardest things to do. Today, what we're going to talk about is how to choose the right whole life insurance product. And what we'll focus on is what products and setups give you the most cash value, and also what products and setups also give the agent the most commission. This way, you can have full transparency as to how the whole life insurance product works and really know what is going on both sides of the table, your side and also the agent's side. So we'll assume that your goal with a whole life insurance policy is to get as much cash value as possible. That's typically the goal of people that we work with. However, the problem is that the industry incentivizes agents to sell life insurance products with less cash value because the lower the cash value is, the higher the agent commission is. I'm going to show you specific examples in a little bit. Now, there are three things that impact agent commission. You have the actual whole life insurance product that you choose, meaning all whole life insurance products are not the same. One product might pay me a 100% commission upfront, whereas another product might pay me an 11% or 30% commission upfront. And you'll also find that those different products have an impact on your cash value as well. The design is the biggest impact of both your cash value and agent commission. I'll hit on that in a moment. And then also the insurance company selection is as well. To make this part simple, when it comes to company selection, I always recommend one of the four major mutual companies, who are Mass Mutual, Guardian, New York Life, and Northwestern Mutual. The simple reason why is because I have seen consistent proof that their policies have delivered strong cash values to policyholders. And when you look at commissions that are paid with those companies compared to other companies, those companies do tend to pay less in commission. Just when you look at it, that's how it works. But let's start with the design, and then I'll talk about some different products. So with the design of a life insurance policy, a lot of times people think, I buy a whole life insurance policy, I pay a premium, and that's it. Not the case with whole life insurance. You can actually choose where your money goes. If you're going to pay $1 into a policy, it can go toward what is called the base premium or toward what is called your paid up additions rider. I like to call the base premium the initial insurance expense and the PUA rider a cash dump-in. Here's how both areas work with respect to your cash value and the agent commission. If you were to put $1 into your premium, that would give you the least amount of cash value, especially with a traditional whole life insurance product, and it would pay me, the agent, the maximum amount of commission. Whereas any dollars you pay toward your paid up additions rider gives you cash value immediately and pays me a very, very small commission. With the major mutual companies, you usually see the PUA deposit commission somewhere between 2 to 3%. The base premium is much, much higher. Next, we've got products. So there are a lot of different types of whole life insurance products that are available. Here, we've got 4 products, and these are all with the same company, all with Mass Mutual in this particular example. First, we have the most common type of whole life insurance product that is sold, their Whole Life 100 product. The 100 represents the age that you can pay premiums until if you wanted to. Nobody ever does that. Then we have their High Early Cash Value product, their 15-pay product, and also their 10-pay product. I'll go through each 4, but first, let's look at an example of the Whole Life 100 and talk specifically about the design, and I'll explain how your cash value and the agent commission is impacted by the design. So what we've got here is the same product, a Whole Life 100 product. And what you'll see here is this individual is paying a lot of money. He plans to pay $100,000 per year for 15 years. His cash value is right here. The first year is $65,000 and change. Now, keep those numbers in mind. And when we look at the next illustration, you'll notice that it's the exact same product with the exact same company. And he pays the same out of pocket, $100,000. But instead of $65,000 in cash value, he's at $83,000 in change. Why? Here's the difference. Up here is your base premium. This will follow the column or line up with the column base policy insurance. $10,000, that's the premium with the example where I had more cash value. If I go back to the less attractive option where I had $65,000 in cash value in the first year, my base premium was $30,000. The higher the premium, the lower the commission, especially up front. Let's look at these two side by side, and I'll show you exactly what I would make in commission if I were to sell you either of these options. So here's the first one. This is what we just looked at. The first year cash value is $65,000 and change. And by year 15, he's paid in $1.5 million, and he has $1.8 million, almost $1.9. Okay, let's take a look at the commissions. With this policy, this is exactly what I would make based on my current rates with MassMutual, my commission rates that is. The first year would be just under $30,000. There are renewal commissions that are paid typically for 10 years with most whole life insurance companies and products. Sometimes they pay a small renewal after the 10th year. But over 10 years, I would earn a total of $55,000 and change. That is what I would call the lifetime value of this product sale. Make sense? Okay. Now, let's look at the second option, which gives you more cash value. So when you look at this option, exact same product, you've got almost $20,000 more in the first year, and you have more than $1.9 million by year 15. More from start to finish. If you look at the bottom, by year 20, that gap is widening in favor of the example to the right. So you have more money, yet the agent ends up with less. Look at that. By reducing the premium, you get more cash value, but the agent will make less. That's just how it works with whole life insurance. So it's about $11,000 and change up front, and over 10 years, it's about $32,000. So that's a comparison of just the Whole Life 100 product. Now, the Whole Life 100 product is the least attractive product when it comes to getting a whole life insurance policy with as much cash value as possible. That would actually be the last option I would recommend if we were focusing on MassMutual products. So if we were to look at those four options, in fact, let's do it this way. Here we go. The Whole Life 100. What that produces is a low cash value compared to their other products, but the highest agent commission. If I were to look at the high early cash value product, the cash value I would rank in the middle. Medium, meaning more than the Whole Life 100 product, but it's still going to be noticeably less than other products that they offer. Now the commission structure on this product is the lowest up front, but over the long term, it's about the same as the Whole Life 100. So it's still lucrative to an agent, but they really have to be focused on the long-term performance in terms of revenue for their company or their personal practice. The 15-pay product, the cash value performance is high and the commission is low, whereas the 10-pay product will offer the highest cash value, but the lowest commission. So let's take a look at those side by side. And what this analysis is going to show is as follows. We're looking at examples with the same insurance company. We're going to look at the same design, meaning all four of these options are going to be designed with a $10,000 minimum premium, which is us pushing it as low as we can. But then we'll look at the three different products. And we'll analyze the value to you, that is specifically the cash value, and then the value to the agent that you're working with, which is specifically the agent commission. Let's take a look. So, to start, we've got the four illustrations up. We'll start with the Whole Life 100. Then we'll look at the high early cash value. There's your 10K minimum premium. Then the 15-pay, 10K minimum premium, and also the 10-pay, 10K minimum premium. All right, let's take a look on Excel to keep things simple. First, the Whole Life 100. This is the example we just looked at. When we look at this guy, what would we earn in commission? Over 10 years, about $32,000. This is the same example we just looked at. Comparing that, though, with the high early cash value product, what do we see here? Well, first, you pay in $100, you've got $92,000 in the first year alone. Your break-even point is just about year 4, meaning at that point in time, you've paid in a total of $400,000 and you have about $400,000. And if we look at the bottom, by year 20, you've got about $100,000 in additional cash value with that high early cash value product compared to the whole life 100 product. To pause here, this option is the option that is most commonly sold. Whether it's with MassMutual and most insurance companies, is your traditional whole life insurance product. However, we see more money for the consumer with the high early cash value product. How do the commissions work? Meaning, what is the agent's incentive? First year, a lot less. You can see why this product is not always shown. However, over time, we don't see any big drop off in renewal commissions. And the 10-year lifetime value of this sale is just about the same as the example to the left. In fact, it's about $1,000 higher. So I make a little bit more. It is spread over 10 years though. That's with the high early cash value product. What about the 15 pay? Well, look at this. The first year, I have a little bit less than the high early cash value product. But as I look at it over time, it really gets stronger. I end up with more by the 5th year, meaning I've got more with the 15 pay than the high early and the whole life 100. By the 15th year, this is the only example that has cracked $2 million. And over here, I'm almost at $2.67 million. So $2,668,000 by the 20th year. The high early, 2.55. And the whole life 100, 2.45. Same company, same designs, same dividend rate, same health rating for this individual. Just by looking at different products, I see the difference in my cash value performance. Again, if I'm you, the policyholder. And then when I look at the compensation, you can see where the money goes. Like, it's just how the industry works. Yearly commission, less upfront, $7,200. The 10-year lifetime value, $28,000. So we're seeing less in agent compensation as we beef up the cash value. Now, these were all scenarios where we were showing someone funding a policy for 15 years. If we're looking at 10 years or less, I should say, then we'll look at the 10 pay, which to the right, we can see that. On the left, you've got the same HEC fee and whole life 100 funded just for 10 years. But look at your 10 pay. You're at about 90% in the first year, with your agent commission would be about $5,200. And this is assuming that your base premium is $10,000. If I push the premium higher, that would push the commission higher. But if you push the premium higher, you would then push your cash value lower as a consumer. Very important to be aware of that. The lifetime value over 10 years is $25,000, almost $26,000. What do you notice in terms of the trend? If you're interested in a policy and cash value is your goal, that means the agent and agency and insurance company that you're working with is going to earn less. That is just how it works. Now, what I'll say about all of this is everything you're seeing here, as far as juicing the cash value, is typically what is presented and sold to corporations that are beefing that cash value up as an asset on their balance sheet. They want short-term cash value and also long-term cash value. Why insurance companies are okay doing that and why agents are okay doing that for corporations is because if you have a corporation putting in $5 or $10 million per year, yes, that premium is minimized, but it's still quite large, which still generates quite a large commission. It's on a larger dollar amount. The thing is, anyone can do this. Like what you just looked at, that showed $100,000 per year. It could be $10,000 per year. It could even be $5,000 per year. It's really just knowing what to look for, what questions to ask. So what I would recommend, if you are looking at whole life insurance policies right now, look for different products. Ask to see different products with different insurance companies. You can ask what the agent's commission is. If you don't want to do that because that feels uncomfortable, what you can do is just look at your first year cash value. What you'll notice is if your first year cash value is greater than 80%, unless it's the high early cash value product, then it should be greater than 90%. But if I'm in that range in the first year and my break-even point is close to year 5, maybe a year or two earlier or later, that's an indicator that the policy is set up for minimum commission and maximum cash value. If all of this seems confusing, you can certainly reach out to us if you'd like. We do offer free second opinions just to go over different companies and products and really make sure that everyone we work with are getting policies that are set up for as much cash value as possible. Because when people have buyer's remorse, it's when they find out about this stuff after the fact. Hope you enjoyed this one. We'll talk to you soon.